Yeah,
Recording in progress.
we welcome you to this very interesting webinar on the recent Expert Advisory Committee opinions under the India's framework. Today, I, along with our Vice Chair, Piyush Sajetji, welcome each and everyone, especially our two speakers, panelists, I would say, Dr. Avinash Chandraji, who has been the Technical Director at ICI, and of course, the backbone of, I would say, India's in the country, IFRS India's, is par excellence, and he has been regularly contributing to the institute at whatever forums, whether EAC, ASB, since decades. Also, along with him is our another panelist, very well known, very expert into IFRS India's, CA Archana Bhutaniji, who has been again contributing to the ASB and EAC over again since a couple of decades. I'll not say because she looks too young, but yes, I'll not say how much experience she has got. But yes, she has been a regular contributor on the opinion, and of course, to moderate them, we have got CA Prashant Guptaji, again our co-operative member of the EAC, and of course, Parulji is here as a secretary. Just a few points just to tell about Expert Advisory Committee. You know, I feel that most of you who have joined today know about EAC, that this committee, if I talk about, is one of the very earlier committees formed by the Institute. It was formed in 1975. And the first opinion which was given was on 31st December 1975. And it was basically upon, if you talk about at that time when even the accounting standards was not mandatory or notified in the country. Accounting standards came in 1987. So in 1975 on the accounting issues, ICI used to give the opinions. Earlier the research committee used to do. And from then 1975 onwards, because it being a specialized accounting and auditing area on which the EAC gives the opinion, this our expert advisory committee has been giving a lot of opinions, and these opinions are of course shared with public at large. And since 1975, the EAC has given around 1700 opinions. And yearly, if we talk about yearly, maybe required even twice a year, the EAC publishes the compendium of the opinions. And till date, around 42 compendiums have been issued. And 41, 42, 43 now. 43 now. Also now, we have got a digital search portal for the EAC opinions, which you go to the ICI website and you go to that page of Expert Advisory Committee. There you will find that search module where even in the advanced search, you can search all the opinions which have been given by the institute till date. And also when the later opinions do come, all of those are uploaded there well within time before even they can be included in the compendium. This year, if we talk about yearly, we give the opinions. There has been certain thoughts that there is a quite delay when the EAC issues an opinion. Friends, just to tell you, this year we have already issued around 30 opinions, and the pendency which we have is hardly 5 to 6 opinions, which is not more than 2 months, less than 2 months. So you can tell everyone that no, EAC has been giving opinions, and now we are well within time to give the opinions. And today we are discussing upon the various series EAC opinions under the Indian framework, which includes accounting for the GST component on the lease payment under the 116 leases. Then there are 6 opinions which will be discussed by both the panelists and moderated by Prashantji. I'll request our vice chair, who is, I would say, a continuous vice chair. He is now, this is his 3rd year in this expert advisory committee as a chair, who is also the chairman of the direct tax committee. And the knowledge which he possesses, he uses the legal skills which he has acquired during his direct tax practice as a litigator, very wisely used in EAC, ASB, wherever required in the accounting area also, which all the committee members, co-opted members, everyone appreciate. So over to Piyush Sajetji our Central Council member for Mumbai, for his initial views.
Very good afternoon to all of you. Thank you very much, Chairman C. Pramod Jainji, for leading this committee, I would say, and this webinar also. Expert Advisory Committee, as rightly said, I've been associated with this committee for 3 years. And the experience, the learning which we have gained, I think so I'm the most privileged council member to that extent. I also recognize the presence of Dr. Avinash Chandraji, the expert in the India's IFRS or any accounting standard or accounting methods. Thank you very much for joining us today and addressing the audience today. Thank you to Archana Bhutani ji also. She has been also associated with the institute quite a lot. Before she was with Expert Advisory Committee, she was also with the Accounting Standard Board. Currently also she is part of ASB. So both of them have been either been part of ASB or EAC somewhere or other. Kashan Gupta, who would be moderating, and he is also a co-opted member. And thank you very much, all of you, for joining us. Friends, I would just like to tell you my experience of last 3 years. The way the learning experience which we get in Expert Advisory Committee, the technical committee, I think so you will not get anywhere else. The way the discussion happens. This committee comprises of the Central Council members and also experts, accounting experts, experts of accounting standards who contribute. And line by line, each and every opinion has been read by that committee. Generally, every opinion has been discussed. It ranges from 1 hour to 3 hours or sometimes. And you will have a different opinions coming. And it is like a democratic discussion which happens. Sometimes
over the days also.
Over a period, over a days, over adjourned meetings also. And sometimes we have to actually adjourn it twice, we have to relocate it. But what I'm trying to make a point is a lot of efforts are being put by all the experts. They give their honest opinion and unbiased opinion. And I will tell you the impact of such. Lot of CAG, whenever CAG has an issues, they will always try you please get an opinion from Expert Advisory Committee. Whenever any ministry has an opinion, we have got a lot of opinions wherein they are actually been initiated by ministries. Wherein ministries are saying that how this accounting should be done. It's a very typical accounting, and whatever EAC says, and I'm not saying institute, we have received letters in the past wherein they have said ministries that you take an opinion from Expert Advisory Committee of ICA. Obviously, EAC is a part of ICA and it's a recognition of the Institute of Chartered Accountants of India. But it is the opinion which are completely unbiased. It's driven purely by the knowledge which the members, the committee members, the co-operative members possess, who discuss thread by thread. It's very important. Why I'm trying to tell you this background is when you be there for 2 hours, please believe me, you will realize what has gone into making of this opinion. You may be reading accounting standard in this, you may be expert of it, but what was the thought process behind why such opinion was there? When you read an opinion, probably you may agree, you may not agree with that particular opinion. But what was thought process which went into coming at that opinion is more important, which will be discussed in this webinar. I think so that will bring clarity on a lot of issues. The issue today which may be discussed may not be relevant to you today. You may not be working in that particular industry. You may not be applying India's, or you may be applying more of AS. There may be certain members who may not have a clients applying in India's. But the question is the principles, the thought process, the discussion which has went into that opinion, which will be coming up today. So my request to all of you, be very attentive of to us. Generally, EAC does a lot of minimum seminars. We don't do much of seminars also because those are very important topics. And there will be always different views also coming up. But this time we decided, and Chairman Sir also said that we should do certain seminars. We have been doing seminars last year also, but this year our more concentration has been on the opinion giving, that there should be no pendency at all. I think so we have done well under the chairmanship of Pramod Jainji, who has been concurrently keep fixing the meetings, or it will be adjourned meetings or the new meetings, to see to it that the people, the opinion seeker, the corporates, maybe the government, they do not actually, they get the results, they get the opinion well within the time. So my request to all of you is please be attentive. I'm sure you would find it very useful. Another request to you is whenever you are deciding, whenever you are in dilemma, what is, how the implication of India has to be done, please do go into the website of Compendium of Opinions. It's very easy. So if you want to, you can search that website based on the any keywords. You can just say India's 118. You can just say a particular industry. If you want to talk about oil industry, you will get all the opinions related to a particular oil industry. That will help you in determining whether what opinion, what to all of you, please be attentive. If you have anything else, please do tell your auditors that expert advisory opinion is as good as, though we always say it's not binding, but it has a value which has a regulatory backing, and lot of regulatory bodies do respect to that. That is the most important when I'm coming to. Thank you very much, Chairman sir,
May I
for
just
giving
to-
me this opportunity.
May I
Yes,
just
Chairman
to
sir.
add quick- You know, when anyone sends a query, there is our service rules for this, which is available on our EAC website. When that query comes, of course, it is fee based. The only committee which charges fees for the opinion, but the fee is very less. The office works over it. Parul and our whole team, they actually take time to draft an opinion, and wherever required, they take help of certain expert also. Wherever required, very less. But yes, when they prepare after that, it comes to the committee where you said that all the experts then deliberate and then again and again.
And definitely, I will make it very clear point to you. When the office drafts it, there are situations when chairman and vice chairman are not with the office. So it's such a fair discussion which happens, and you never know what the views will emerge, because ultimately it goes by what the majority views. And therefore, it's very important that this opinion carries a weightage amongst all the regulatory bodies. That's the more important. So thank you very much once again, sir. Over to you, moderator Prashantji.
Good afternoon, everyone. And first of all, thankful to the committee for giving this opportunity to moderate the EAC program, this webinar. On the personal level, I have noted that the working of the EAC is very complex because very thin line and complex matters are discussed, which the queries have asked from the committee to give their valuable opinions, and both internal and external members give their time, give their opinions, and which differs from each other most of the time. And especially Dr. Avinash Chandraji plays a very crucial role in framing those opinions. Pramod sir rightly said he's the backbone of this committee. And I will advise everyone who practices this accounting and auditing consultancy or undertake stat audits to go through this compendium of opinions, because generally the queries who have asked the committee to give their opinions generally deals with the very large financial statements, and those principles can be used for our clientele also, which maybe have medium-sized financial statements, small-sized. And personally, I have noted that these opinions have benefited me for using in my personal in this official capacity also. And but there is one limitation and limitation of scope which should be kept in mind by the readers of the compendium of opinions, that very specific facts are discussed, which may be different from the one who is reading these opinions. We cannot use as such those opinions in our day-to-day practice. We have to read these limitations, read the specific facts, and see whether our facts are falling into that category or not. Further, these opinions are just for reference purpose only, and we cannot use these as a legal remedy for any proceedings before any authority. We can just take the guidance of the principles specified. There are in the opinions there are points considered by the committee paragraph, which is very useful. We can take guidance of those paragraphs, principles, which have been specified in the final opinion paragraph. And today we are discussing we will discuss the opinions which the committees thinks which will be benefit a large number of our participants, and which are very useful to this our members at large due to their complexity involved. And I will start with this presentation. This is just the limitation paragraph specified in the presentation. Now going with the first opinion. In this case, the committee was asked what will be the accounting treatment for the GST component charged from the company for the right to use assets. So company had taken the premises on lease, and the company is dealing with the exempt services. So there is an educational material from the ICAI for India's 116, which guides the query whenever GST input is available. But in the specific case, GST input was not available to the company, and the company has recognized the right of use asset from using the total value, basic plus tax component, and discounted the GST component also to arrive at the right of use asset value. And that ROU asset was amortized by the company as per this depreciation policy, which the company following as per the accounting policy adopted by the board. Now the stat auditor have observed that the company has considered this 18% value on the basic amount to arrive at the ROU asset. And the auditor was of opinion that this GST component should not be used by the company, and only basic amount should be used to calculate the right of use asset. And the GST component should be charged to the profit and loss in the year in which it occurs. So the said company is electricity generation company, and no GST is chargeable on this electricity component, and it is exempt from the GST purview. So there is no question of GST input in the books of accounts. Now the queries have asked what should be the accounting treatment of this GST component on the rental amount. Should the same be charged to the profit and loss account, or should the amount be considered for the ROU asset calculation? So I will request Dr. Avinash Chandra ji to give his opinion and explain the participants about this.
Yeah, thank you very much, and good afternoon to everyone. At the outset, let us try to understand that why this query has arisen. Primarily, it appears that the query has arisen because the lessee is apart from the other part of the lease payments, that is the use of the asset. Even for GST payment, the payment is made to the lessee. So the understanding, the question therefore is that whether, since the lessee is making payment to the lessor, whether this GST would also be included as a part of the lease payments for the purpose of computation of the lease liability and the ROU asset under Ind-AS 116. So primarily that was the question, how this question arose. And secondly, the queries, if you may know, he is saying that the lessee, that is the lessee, will not get any input credit. So in that situation, he will not be able to take the benefits of the GST the lessee has paid. So the question therefore is in that context also, that if the lessee is not able to avail this as an input credit which is payment, whether it should still be excluded from the lease payments. So the committee therefore first considered the requirements, the specific requirements of Ind-AS 116. And in that context, what are the requirements, particularly of what should comprise the lease payment, And the ROU, as you are all aware, the measurement of the ROU also depends upon the measurement of the lease payment. So the whole focus is therefore on whether the GST would fall within the definition of lease payment. Now, if we look at the definition of lease payment, there is a specific requirement which is there. The lease payments, I just read one sentence only. Payments made by a lessee to a lessor. Now, the word which I am going to read are more important. Payments made by a lessor to the lessee to the lessor relating to the right to use an underlying asset. Now, this is very important, that the payment should be relating to the right to use an underlying asset. Now, so therefore, the question arises whether this GST payment is related to the right to use an underlying asset, or it is unrelated to the right to use the underlying asset. Although one may argue, I mean indirectly, that had the lessee not obtained this office premises on lease, he would not have to pay the GST payment. So therefore, they are related to the right to use the underlying asset. But then the committee also looked into as to what is the nature of the GST payment. So, in other words, what is the nature of the GST as a tax? So there the committee noted that the GST is a consumption-based tax. That is, GST is levied by the government on customers for consumption of services, and it is a statutory obligation for the person who is consuming those goods and services. So the primary obligor in this for this tax is the entity which uses the goods or services. So here, for example, in this particular case, the primary obligor would be the lessee. So even though the lessee makes this payment to the lessor, so what the committee had that this lessor, even so the lessee is making the payment to the lessor for the GST, the lessor is acting more an agent of the government, as a collecting agent of the government. So taken together both these requirements, the committee concluded that look, this GST is something which is other than, which is related to the right to use the underlying asset. It is a kind of a tax which the lessee has to pay for the use of the of his premises. So therefore, the committee felt that this GST should not be included as a part of the lease payments and ROU, and therefore it would not form part of the ROU asset, and it should be therefore excluded. Now this conclusion the committee reached, and it specifically noted that it does not matter whether the lessee is able to obtain credit for these GST payments or input credit. That does not matter. So irrespective of whether the lessee is able to obtain this input credit, the treatment should be the same. That is, so therefore, in conclusion, one can say GST will not be included as a part of lease payments, and therefore it will not form part of the ROU asset. Secondly, the committee noted that this GST is a kind of a levy, and therefore it is covered by Appendix C to India's 37, which is on levies. So when you apply the principles of that Appendix C, that is levy, this GST will have to be recognized and separately as a tax, and separately as a tax in the profit and loss account in the period in which the requirements of that Appendix C is met. That is when it becomes payable. So broadly, that was the conclusion of the committee insofar as this opinion is concerned. So Archana, would you like to add something on this?
Yes, I think you've already covered some of the nuances I wanted to pick up in this one, but I'll just take a few more so that the participants get a comprehensive understanding of the implications of this particular concept. I think just to reiterate, it is very critical, like you said, if I look at the definition of lease payment, it says payment made by a lessee to a lessor. Of course, you've gone further, but that is where you look at who the primary obligor is. Intuitively, we think, okay, you've given it to the lessor, how is it not a payment to the lessor? But you need to see whether the lessor is just a pass-through. Now, in the specific context of GST, we've said the lessor is a pass-through, but I think for the participants, if you're looking at, let's say, other countries, you have, let's say, subsidiaries outside India, etc., you will need to look at the value-added tax or sales tax requirements in individual jurisdictions to see whether or not the lessee or the lessor is the primary obligor. So if lessee is the primary obligor, which is the case in India, then we have the position, sir, like you discussed. And the big learning which comes from here is that it doesn't matter whether it is refundable or not refundable for the lessee, as long as the primary obligor is the lessee, it will not be part of the lease payment. Obviously, if on that, I'm just flipping it, if the lessor was the primary obligor, let's say in a particular jurisdiction, then comes the question, is this a lease payment? So in the first case that we discussed, for the lessee, it's an executory payment, just like any other period cost, you'll keep on taking it to P&L. My question is, if lessor was the one, then would we then take it to ROU and so on? And there again, I mean, before we jump and say, okay, lessor, the answer will change. You need to see how the payment will be made. My understanding, sir, is that if, let's say, as a lessee, I'm making the payment over the period every month, I keep on making as and when the lessor, if the payment has to be made. Even then, it will be, even if the lessor is the primary obligor, it will become like a variable lease payment. Right? And then you may not still take it in the ROU, but if I make the payment upfront at the time of inception of the commencement of the lease term, then it will become part of the ROU. So the point I wanted to make is first look at the jurisdiction requirement. Is the primary obligor the lessee or the lessor? Lessee, we concluded irrespective, it will not be part of the lease payments. Lessor, even there you could have situations where it is not, it is part of the lease payment, but because it is variable in that context, if it's linked to the basic lease amount and the lease amount changes monthly, then it could be that it's still not capitalized as part of ROU. So I just wanted to kind of highlight that nuances. So if you want to kind of add anything here, and I also recollect that IFRIC had discussed this in one of their agenda decisions. They actually did not give any view on it because they felt that first they did not find it to be material, and secondly they did not even find any significant divergence. And that is where, if I can just take 30 seconds to kind of reiterate the relevance of the EAC opinions. Actually, you see, there's so many matters on which even the globally, you don't get a very specific response. But EAC, you still, I think India is the only one wherein you still get these very specific situations considered by the regulator. So, sir, on the overall.
You have touched a very good point. And so obviously, as Mr. Gupta also mentioned, that the EAC opinions are based on the facts and circumstances which are there in the query. So in this particular case, so that was the opinion EAC arrived at. What Archana is pointing out is a further, you can say, an addition that you simply do not rely on the EAC opinion blindly. So you look at, for example, as she mentioned, that if suppose there is a subsidiary of an Indian company, and in the subsidiary of an Indian company, in that country, the law is different compared to what we have here in our case. So then the facts change. So if the facts change, then you factor in those facts and then reach that conclusion rather than simply going by what EA is saying, EAC is saying. And actually, IFRIC, another reason could be that IFRIC might not have tried to give an answer because the IASB deals or IFRIC deals all over the world. So they do not know in which country which law is prevailing and what is the law. So therefore, all these facts are very important. And in other countries, this opinion is in the context of the legal requirements prevailing in our country.
Thank you to both the panelists. So we learned from this conversation that in India, what will constitute the lesser payment. So we have three scenarios. Input will be fully available, input will be partially available, input will not be available. So in all the three scenarios in India, we will not consider the GST component to calculate the lease liability and right of use asset. And further, this opinion cannot be used blindly uh, for matters which may be related to other jurisdictions. We will have to check the jurisdiction wise tax laws. Then we will decide whether the same will be considered as a lesser payment or not. So the test will be, is it a pass-through payment or not? If it is just a pass-through payment, then it will not be a lesser payment and will not be considered. So moving on to the next query. So in the next query, the matter was there was a company which is a joint venture between the Government of India and the Government of National Capital Territory of Delhi. So this company was incorporated for the rapid transport system in the NCR region, and they got finance from the Government of India and which was interest-free subordinate debts from the Government of India, Government of National Capital Territory of Delhi, and other government agencies. So these were the funding pattern of the to execute the project of the metro. So as per EIR method, the interest-free subordinate debts was discounted using this GSEC rate to arrive at the actual value of the loan, and the balance was transferred to the grant component. And this grant was amortized over the period of this project. So the company was completing the project in four phases. Now the company which has measured this interest-free loans at this discounted value, so the loan interest was further loaded on every year-to-year basis to calculate the notional interest, the terminology which was used by the queries in this query. And further, the the company had some interest income on these idle funds, because we cannot mobilize the funds right from the day in which it comes. First of all, the fund came, then this project funding pattern is decided, then how the same will be spent in decided, and based upon these timelines, this fund is used and to protect the public interest, these funds were invested in these fixed deposits to earn some temporary revenue to avoid the loss to the government. So the question under this query came that whether the interest income on these temporary funds should be deducted from the notional interest cost or it should be credited to the profit and loss account. And further, the main query, which was the notional interest, which we have calculated using the EIR method, should the same be debited to the capital work in progress or project cost, or the same should be debited to the profit and loss account. The auditor observes that assets includes finance cost, which is just a notional in nature. So the auditor was referring that actual borrowing cost should be debited to the project cost, not this notional interest. And further, there was, I remember in this query, he had used the reference for our earlier EAC opinion also, and we had decided that how this opinion is different from the earlier decided opinion. So these two questions, that what should be the accounting treatment of this notional interest cost? Should it be debited to the project cost, CWIP, or debited to the profit and loss account? And what will be the accounting treatment of the interest income? Should the same be credited to the project cost or the same should be credited to the profit and loss account? So I will request ma'am to give her opinion on this matter.
Thank you. What I'm going to do is just very quickly summarize just the requirements, and I think the answer then flows very smoothly once you appreciate what the standards require. Now, when you look at the accounting for a debt or a loan, under Ind AS 109, you would do the initial recognition at fair value. The consequential implication is that when you do fair valuation, if the loan is given at an amount which is either nil or not at fair value, the interest rate is not at fair value, the accounting would still take into account the fair value, the arm's length interest rate. So you would land up recognizing the interest which is equal to a fair value interest. The difference between the fair value interest and the actual interest, the difference is obviously attributable to something else, and that is what you look at in each case. Now, in this fact pattern, when the interest was received, when the loan was received at nil or a zero rate of interest, under the requirements of Ind AS 109, you would still impute interest using the arm's length or a fair value interest rate. The difference, the nature here is because it's coming from the government as part of a grant. The difference is actually nothing but the benefit that the government has given to you. So the benefit is from the government is coming to you in the form of an interest free, that interest which the government is incurring on your behalf. Now, in accounting, you would recognize the interest. You're not saying I have not incurred any. You may not have paid. The cash outflow may have been nil, but the economic reality is you have incurred. There is a loan. That loan involves an interest, but that has in a way been borne by the government on your behalf. And therefore, the accounting says you recognize interest with the corresponding government grant. So that's all this accounting is trying to do, that you do the initial recognition at fair value and then subsequent measurement at amortized cost, and this interest, which is nothing but benefit which has come to you from the government, is recognized for the period. Now, I think that's the first thing. I think if I look at the queries concerned, they seem to think these are just book entry, and that is why I think Prashant referred to it as the queries referring to as a notional interest. Clearly, EAC has concluded this is not notional. It is just that there is no cash flow. On one side, yes, the loan does have an interest attached to it, just that the government has borne it on your behalf. It's kind of given you the grant in the form of relieving you from the actual cash payment. And that does not necessarily make it notional. Now, the question is that does this kind of an interest, which I impute, and I'm using the word imputing this so-called rate of interest, does it become borrowing cost as far as the standard is concerned? When you look at the requirements of India's 23, it says borrowing costs are interest and other costs that an entity incurs in connection with the borrowing of funds. And therefore, somewhere the discussion in the CAC opinion also goes to what is the interest. When I do this kind of an entry wherein I've done an interest with the corresponding government grant, doesn't mean I've incurred, okay, a borrowing cost. And that is, like I said, the EAC said this would be considered as an expense which is being incurred. It is not notional in nature, and it will meet the definition of borrowing cost. And then you move on to the requirements of India's 23 to see how this borrowing cost has to be accounted for. When you look at how do you account for it, the standard clearly says that the entity shall recognize borrowing cost as an expense in the period in which it incurs them. So again, then it will become borrowing for the relevant period. The second part, and I'll come to this one back again. The second, I think maybe the earlier opinion also that
Yes.
Prashant referred to. If you look at an earlier EAC opinion, I think the earlier EAC opinion was in the context of AS 16.
This high gap framework.
Yeah, which did not have the concept of this so-called, under AS regime, you do not have this concept of imputing the fair value of the interest rate and accounting for it. So the definition of borrowing cost, if you look at the components of borrowing cost, they were clearly different under India's 23 and the AS. In fact, when you look at the borrowing cost examples which are given in India's 23, it clearly says interest expense calculated using effective interest method as described in 109. So this interest which is being recognized in this arrangement is clearly as per effective interest rate method described in 109 and clearly gets covered. So while there are many similarities, if you look at the previous standard, not the previous, the AS standard and the India's, conceptually there are a lot of similarities. So this is where certain differences have come in because the concept of accounting is not there itself in AS, right? And this is very integral to India's, the concept of discounting. So there are some differences between the two. The second part which was raised in this is what to do on income which is being earned on this surplus. Let's say I got the loan, I did not need to use the entire loan immediately. The utilization will happen over a period. The surplus loan I have invested some, maybe kept it in a bank, getting interest or whatever. How do I prove or account for the interest income? The standard clearly distinguishes between borrowings which are specific and borrowings which are general. When I say specific, it means specific to the construction of that asset. Now, in case the borrowing is specific for the purpose of obtaining a qualifying asset, then it can be adjusted from the interest expense. But if it is a general borrowing, then you cannot offset the interest income from the related interest expense. And I think in this case, it was a general borrowings, and therefore, it was a general borrowing, specific borrowing. It was a specific borrowing. So you should have actually, the company should have adjusted the interest income from the interest expense. I think these are the two key points which come from this EAC opinion. Like I said, again, be careful when you're referring to the earlier EAC opinion. The standards may be similar, but not exactly the same. And look at again the requirements of the standard before seeing whether it can be applied to a specific circumstance. In this one, I would actually request, sir, if you can just add on some clarity on this word incurred, this concept. How should someone understand incurred? Because I thought that was that was a key issue here. This concept of what is incurred, what is notional.
No, as I understand, and as the EAC also said, that if something is considered as an expense or expenditure under the conceptual framework, then when that expense or the relevant expenditure is to be considered to be recognized, that should be considered as the point of incurrence also. Like in this particular case, the interest the company obtained the loan at without paying any interest. So the question was that, I mean, probably the confusion arose that since there was no payment of interest, so why should the cost of the asset, because the asset was under the construction stage, why the cost of the asset should be loaded with the interest, which is actually not paid, there is no cash outflow. So why you should inflate, so to say, the cost of the asset? That was probably the doubt in the mind of the querist and maybe the government auditor also. So here, as the EAC also looked into, the interest has been considered to be incurred because the because of the principles of the index, that when you fair value the loan, the question of fair valuation, as you mentioned, the fair value of the loan, you fair value the loan keeping in view the fact that the market participant would have paid interest, right? So the fair value would factor in the interest payment also. So when the interest payment is factored in the fair value, naturally it has to be accounted for. Now, when it has to be accounted for, then the question arises how to account for it. So on the one side, it is treated as a grant, as a government grant. And on the other side, it is treated as an expense or the expenditure, because even though there is no cash outflow which has taken place, but you have obtained in a way the benefit of that loan, for which you would have incurred the cost had you obtained the loan with interest. Now, I mean, that is primarily I think the principle behind this, that what is the definition of expense? So definition of expense here as interest would be met because there is an increment of this amount of the difference which you would treat it as a grant. So one thing I would like to add here, I mean, although we actually, in the EAC opinion, after the facts of, after the query, there is the first paragraph of the opinion, which includes, the scope, exclusions and inclusions. Now here, in this particular opinion, the EAC has excluded from its scope that how would you treat the government grant? That the EAC has not gone into that question. And rightly so, because that question was not raised by the query. So it is possible, I am just speaking aloud. I mean, I am not saying that that would have been the opinion of EAC. That supposing we go into the question of utilization of grant also, the question may arise, how do you recognize that grant, right? Now, that grant is received. One can argue that that grant is in relation to the asset which is being constructed. So therefore, on the one side, you have this expense which is being recognized over the period, or which is being added to the cost of the asset. On the other side, this grant is being used for the purpose of the construction of the asset. So you might have reduced the cost of the asset as per the requirements of India 20, where you are allowed to reduce the cost of the asset. So in other words, what I am trying to say that had this treatment been followed, possibly the interest which has been loaded in the cost of the asset and the grant which is received from the for the purpose of this asset in the form of interest-free component, that would have offset each other. So ultimately, it might not have affected the cost of the asset at all. But that I'm just adding from my side, because there are many other things which need to be considered when you consider the treatment of the grant as such, whether it is asset related, how it should be, whether it should be added upfront in the cost of the asset or to be added over a period of time, like this EIR is, accrues over a period of time. So whether the grant should also get accrued over the period of time during construction period. So there are many other questions. I'm just, speaking from a very broad perspective.
If I can add a few points there. One is, even if I was to, I appreciate the EAC opinion, it will not get into how to account for the grant, but just a word of caution there. First, I need to see, does it meet, for me to be able to capitalize, one, whether it meets the qualifying asset, let's say if it meets the qualifying asset. Second is, the loan period could be 7 years, 10 years, or whatever. The construction may not be entirely that long. The loan, so even if you do capitalize, please do not take it that you capitalize the entire, so there could still be a difference that the period over which it's only till the construction period as per whatever the borrowing cost as per, sorry, one is the borrowing cost, the other is the government grant. So you need to see, can I really say it is attributable to that and how much I can capitalize. The second is, sir, I think the point I was trying to highlight is that what is incurred would I not look at differently in ES and NDS? I actually thought incurred was, we all understood it's a proof. I have incurred it. But here, because of the discounting concept, what is incurred becomes different. And since we're on the government grant, the fact that this below market rate of interest is a government grant is also recognized in NDS 20. So if you look at NDS 20, it says benefit of a government loan at a below market rate of interest is treated as a government grant. Now, if I was not going to recognize the interest, right, then there is no way I could have recognized this grant, so they both had to come in. And then, like I said, if you look at further India's 23, it recognizes that such interest accrued or incurred is actually a borrowing cost. The other, just to take this forward, it's not just the low interest or a below market rate of interest. This difference is also in other forms of government grants. So one is the concept of discounting, which leads to a difference in AS and NDS. Also, you may want to note that in AS, typically only when you receive cash is where there is a government grant. If I had a reduction of liability to the government, that was not considered as a grant under AS, but under NDS, it says it doesn't matter. There is a specific paradigm which says the manner does not affect the accounting. You may receive it in cash, or it could be a reduction of liability. So this also, in a way, connects to the reduction of liability. While these are two separate paragraphs in the standard, but if you think about many government grants, we will give you a waiver of, let's say, electricity cess or this cess. These are waivers. Under you don't really let them, it's a reduction of liability. Under AS, these were not considered as government grant, but India they will. And I think that is how it applies. So while broadly the concept of what is an incurred cost, I found that very interesting. I thought it was well understood. I would have expected it to be the same. But given this concept of discounting, and also, I also appreciate the fact that in India's 20, they're not going by just cash flow. So even something being waived doesn't mean the expense was not incurred.
Thank you to both the panelists. So we understood that cash flow is not necessary to understand the meaning of this word incur. So even reduction in the liability and reduction in the future cash outflows, it is also a grant, which was the concept was not there in this AS framework, but the same in India's this grant and this discounting and fair value is calculated separately. And Sir has rightly said, we have not touched the manner of the amortization of grant. it could be credited to this project cost. It could be amortized to the profit and loss in the manner of interest payment, thereby nullifying the impact of this notional interest. So the same topic was not asked by the queries, and therefore it is not touched in this opinion, and the same has been specified that the EAC committee has not given opinion on this aspect, and there could be some more complication because this is just an accounting framework. We have debited this notional interest to the cost of project. Whether the same will be allowable in the income tax, will it be treated as the actual cost? So these questions are still pending, and this will be dealt by this direct tax forum. So moving on to the next query. This is related to the trial run expenses incurred by the restaurant chain of businesses. So the company was engaged in this operating of luxury restaurants, and every year the company opens 8 to 10 new restaurants across the country. And to ensure this uniformity of the cooking methods, uniformity of the taste, uniformity of the presentation and decoration, so the rehearsement is done by this restaurant prior to the opening. So this consistency help the company to maintain the high standards, that a uniformity is maintained by the chain of restaurant in every new outlet opened by the company. So the restaurants deploys many machinery equipments, kitchen equipments, and this air conditioning, freezers, audio visuals equipments, and this STP plants, fresh air exhaust systems, LAN Wi-Fi, and the company prior to the opening of the new outlets ensure that these equipments are functioning properly and the desired results are coming from the first day of operation. Further, the food test and the calibration of equipment, these activities take about some month time, and it involves the human resource, and the company incurs salary expense, the company incurs this consumable expense of this food to test that the uniformity is maintained or not. Now the company, because these expenses were incurred prior to the commencement of the outlet, the company intended to capitalize these salaries as the part of construction cost. So these expenses were not debited to the profit and loss statement. Now the question which arises, that whether these employee benefit expenses, whether these food and other consumable expenses will it be capitalized to the construction cost, or the same will be debited to the profit and loss account in which they incur. I will request Dr. Avinash Chandraji to give his opinion on the same.
Yeah. Thank you very much. Actually, in this particular case, as it has been pointed out in the facts of the query, that during this one month before the commencement of operation by the outlet, the cost, there were employee costs, that is one type of employee cost, that is salaries, etc., paid to employees, in testing various food items preparing various food items in accordance with whatever is their standard recipe, etc. And so that, since they have many units all over the country, so that the taste is uniform for the same dish as compared to the dishes in the other outlets. So they are in a way training the employees, the chefs and the cooks and the others who are involved in the preparation of these food items, so that they arrive at the similar consistent taste on the standardized taste. So that is the objective of making, this 1 month. Otherwise, what has happened is that otherwise the outlet is ready. That is, the kitchen equipment has been installed, the air conditioners have been installed, the furniture may or may not be installed. So, but whatever is necessary for the preparation of the food items is already those particular kitchen equipment and machines, etc. They have already been installed. The second question is with regard to the materials which are used in the preparation of these food items. So whether these material costs which comprise these food items, whether these materials can also be capitalized as a part of this particular, during this particular period. Actually, the committee, first of all, decided to identify that even if we have to capitalize these costs, how these can be capitalized. One way is that whether these costs can be capitalized as a separate asset on its own. In other words, this could happen, for example, if supposing, if in the case of a first restaurant, the first restaurant which is being opened, these recipes, the manner of preparation, if let us say this a patent is taken, sometimes some restaurants have signature dishes. So these for signature dishes, supposing a restaurant wants to or intends to take some a patent or some intangible asset. But actually, that would happen in the case of the first restaurant which is being opened. For subsequent restaurants, it is only being replicated. So if, let us say, there is some specific ambience of a restaurant, like say rainforest ambience, which is for which the restaurant takes a patent, or if there is some recipe for which the restaurant wants to take a payment, then it is possible that that particular recipe or a patent which meets the definition of intangible asset under India's 30A, it is possible to capitalize separately as an intangible asset. But then the EAC, as is the practice, since this issue was not specifically raised, so they said that we have not looked into this question. So why this question became important, that if we have to capitalize this cost, then what is, with which particular item of asset these costs can be capitalized? In other words, what should be the unit of account for the purpose of which we have to look at whether under India 16, whether they become part of the cost of the asset or not. So here, for the purpose of these costs, as far as these particular items of cost and expenses are concerned, the committee noted that there are different types of unit of cost, or rather unit of items of PPE which could be there, which are capitalized separately. Like, leasehold improvement could be one item. The air conditioning could be a separate item. The furniture and fixture could be another item. Kitchen equipment could be another item. Line and lighting and audio could be another item, or computer system, etc., could be another item. So whether the question was that whether these costs which have been incurred, like the during this test run period, whether they could become part of the cost of the any of these units of PPE. For example, when we are looking at employee cost, whether the employee cost can become part of the kitchen equipment cost. I mean, supposing the criteria were met. So the committee said that here, and then committee also looked at the conceptual framework also about the definition of what is a unit of account, that if the different items of PPE expire in different patterns, like air conditioner would expire, the life of the air conditioner would be different from the life of, let us say, the kitchen equipment. So these two cannot be combined, therefore they should be separate unit of account, and they have separate different economic characteristics. So therefore, the committee felt that in this particular case, it would be appropriate that from the India 16 perspective to consider whether these costs would be considered as part of the cost of any of these elements of PPE. So for this purpose, the committee then looked into that paragraph 16 and 19 of India 16 as to what costs can be capitalized and what costs cannot be capitalized. So I will not go into all of these, in detail. All I'm just going to focus on is that the costs which can be capitalized are those costs which are directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the manager. So this is broadly the principle under India 16, whether they are directly attributable costs as such. And so that is one principle. And because here we are involved, in the question of testing, because the test run, the question relates to the test period. So the India 16 also lays down the principle with regard to the expenditure incurred during the testing. So what that paragraph or subparagraph says is that the testing costs are to be capitalized because they are to be capitalized because they are incurred to find out whether the asset is functioning properly. So these are to be capitalized net of any income which is to be, supposing these dishes etc. are sold during the period, and supposing these were to be capitalized, when the income would have to be reduced. But that was not the question. The income was not the question there. So these are the two things which, whether they are directly attributable costs, and during the testing run, whether these costs are incurred to test whether the equipment, etc., has been functioning properly. Only then these would be capitalized. Then amongst the costs which cannot be capitalized, the EAC highlighted two costs. One is the cost related to opening of a new facility. So here, since this was like opening of a new outlet, so it could be similar to a cost of opening a new facility. So therefore, it cannot be capitalized. And these are of the nature of the administration overhead, etc. So these cannot be capitalized. So then if we apply these tests in this case, particular first, let us take the employee benefit cost. So whether these employee benefits costs whether they were directly attributable to bringing the, let us say, kitchen equipment to the location and condition to be operated in the manner intended by the management. As we have noted that the kitchen equipment was already installed and the employees, they were only preparing the dishes to make it consistent with their own dishes elsewhere. So the purpose was not testing the equipment as such. So if that was not the objective, so it cannot be considered that these costs are fall within that category to test whether the equipment is functioning properly. Secondly, the costs are not directly related to the construction or the acquisition activity because the kitchen equipment, etc., were already installed. And it is also possible in some cases that supposing it was not that kind of a restaurant where they are so particular about the standardized taste and other such things, they could have operated the kitchen equipment the first day itself and sold the output. So it was not necessary that without these costs also, asset could be considered to have reached the intended operating condition. So the kitchen equipment was already in the intended operating condition. So therefore, merely the fact that you are using this equipment during this period to train your chefs, etc., so that they produce identical or similar standardized dishes, etc., is not the it does not fulfill the requirements of directly attributable. So, with regard to the material cost, that is the food and beverages cost, they were sorry, before I come to that, EAC gave one, I would say, a point to be considered by the query itself. That is, supposing there was some calibration in the kitchen equipment or some other equipment, but supposing during the testing period, there was some equipment which had to be, modified or which had to be rectified for the intended purpose. Like for example, let us say the air conditioning plant was not functioning properly. So you have to then modify the whole structure of the plant or something like that. So that the committee said that in case the employee costs were incurred to make the equipment ready or in the position in which it was intended to be used. In that case, to that extent, it may be possible to capitalize only those costs, only to that extent. So the equipment which have already been installed, if that has to be modified or rectified or which is not in accordance with the required parameters, etc., then those costs could be capitalized. Now coming to the food and beverage material cost, the equipment was ready and it was already operational and it was capable of functioning as intended by the management. So the purpose of the trial was to taste presentation and consistent to meet the high standards which the outlet uh, established, and not to test the functionality of the equipment. So if that is the situation, even these food and material costs were not to be capitalized. So, and then the committee and that, these types of testing costs, they do not add value to the specific assets. They do not add any value to the specific assets. Rather, they are for the purpose of meeting the high standards of the dishes, etc., which are to be sold later by the company. So these should be expense. These should not be capitalized. So in nutshell, the committee said that the employee cost as well as the material cost should not be capitalized. They should be expensed, except in the case of the employee cost, if to the extent of the fact that they require any modification or rectification of any specific equipment, to that extent only these can be capitalized. Otherwise, these have to be expensed. So that is broadly the opinion of the EAC.
Ma'am, your comments, please.
I actually, sir, have a few comments on this. I think one is for the participants, I want them to recognize this is not just about a restaurant. I don't think, okay, my client don't have a client with a restaurant, so I don't need to apply these principles. There's some very basic principles or positions which emerge from this. And I think the EAC opinion is on a holistic reading of the requirement, but if I was to look at some of the individual factors which have been considered, I would still read them in this, maybe in this fact pattern has been interpreted in a particular way, but I just wanted to highlight them in terms of how they could be generally read. So first we said is what can be capitalized is purchase cost and then directly attributable. So the whole issue is are these costs directly attributable? So that's what you said, right? Now, in looking at some of the examples in the standard as to what will be considered directly attributable or not considered, you said cost of opening a new facility is not a directly attributable cost. Now just think about it, you're going to open a factory. Now does it mean all the costs, and someone can take a very open-ended meaning of what is cost of opening a new facility. So if I'm opening or let's say I'm constructing a factory, what constitutes cost of opening a new factory? That would not be directly attributable. So it's not the entire construction expenditure that you say, oh, this is just a new factory, it is cost of opening. I think the intention here is to consider those expenses which are not really adding to the benefit or to the value that you get from the facility itself. So for example, if I do an inauguration expense, right, that is cost of opening. I'm opening the new facility, I'm doing an inauguration. It is not going to add any further value to the property. Whatever I can get, the inauguration is not going to increase the value therefrom. So I would actually read the cost of opening a new facility in that context, and maybe my sense is when the EAC was looking at it, you think about it, you open a new restaurant, you may do a inaugural kind of a thing, party kind of a situation. There could be some cost coming from there, but I would typically look at cost of opening a new facility in a manner which is not adding to the future cash out, net cash outflows, you can say, or inflows from the or giving me any further value from the facility. So I think that for me was not that big of an issue. The second is that therefore, when we come to the employees, as first said, are they really directly attributable cost? So to the extent it's very clearly a training cost. I think training cost, I think we all understand, are to be excluded. If it's a training, I would exclude. If it is testing, then testing would get included. But the question is, I think again, when you're looking at a particular situation, and I'll come to that, if you're looking at any expenditure during construction period, what is testing requires very, very careful consideration. Now here, this was a simple case if you ask me of testing of food and so on. But other than that, I'll take a few examples in terms of how to look at testing. And I think in terms of the beverages and food materials, you said it is again not directly attributable. I think again, maybe I would look at it in two bits. If I've got the equipment, I'm not sure the fact pattern. This was done primarily, the consumption of beverages and food material was primarily to check presentation, etc. But if it is not for that, let's say I want to check whether how the equipment is working, does it heat up to this much and so on. There could be some testing, some thing that may get consumed there, but typically it will not be a very material amount. But I'm just saying I would differentiate between what is used for the testing of the equipment and what is just used for looking at presentation, etc. The third bit, which before I come to some further example of testing, the third bit which I wanted to highlight was the discussion on the unit of account. Okay. Again, the way I read this opinion, the way the unit of account has been discussed here is because there is more focus in terms of whether the cost of the employees and the beverages, etc., is part of this. I think from that perspective, I'm okay, but I would read this opinion very carefully. Here, there is the fact pattern is like you said, the entire facility per se is like you were saying, my AC is installed, my factory is my restaurant is as good to operate. Just that my employees are taking some time to kind of learn how to meet the menu requirements. But let's say the construction was still in progress. I would then read this opinion very carefully. I would then not take AC to be a separate unit of account and chairs and furniture to be a separate account. I think if I'm constructing a facility which is to be used in an integrated manner, right? I can't use one without the other. And when I'm buying the chair, etc., it is not to be used on its own. When we talk about cost directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. Now, if the management is not just buying chair because they just want to put the chair somewhere, everything, the AC, refrigerator, the equipment are all to be integrated and then set up as a restaurant. I would look at the restaurant as the overall unit of account, and that's how I will also look at my borrowing cost. Because otherwise, I wouldn't even be able to capitalize the borrowing cost on any of these. But let's say the restaurant takes me time because I'm also going to construct the building. I don't even have the shell. It takes me more than 12 months, then it can still become a unit of account. Similarly, for a factory, you may have the building, let's say you ordered some machinery, but there's further work to be done, for the lines to be integrated, etc. It is not that the machine can be just used on its own. I think that is where we look at the entire factory as a single unit of account. So I would, that's how I would read the unit of measure discussion in this EAC opinion. Because everything was already ready, I think they were trying to see whether the employee cost and the beverages, etc., can be part of that unit of account. But otherwise, like I said, facts and circumstances. Coming back to the testing expenditure, I think some bits we can discuss here for the benefit of the participants. Generally, we've seen there's a very liberal view taken in terms of what is the testing period. So if I was to just take this restaurant example, I can't say, listen, for 3 months, I'm getting the customers, I'm cooking the dishes, I'm selling them, and I'm still in testing period because I'm trying to see whether the menu is as per what I wanted, is it really picking up the way I wanted, and so on. I think it is all about the test is instead whether it is ready to be operated. So quite often we've seen that in practical, when you look at how this is being put in practice, a very liberal interpretation of the testing period is taken. I think testing period, we typically would not expect too much of income also, sir, to come during the testing period. Let's say if I have a factory, I'm doing a run of my production line. You would not be continuously kind of producing outputs for 2 months and selling them at a particular rate. Typically, the income also that you get during the testing period is more from a scrap sale because you're looking at the nature of products and you're scrapping it. You're not looking at a normal course of business. You sale in the normal course of business. So I think when to stop capitalization becomes a very critical factor. And the reasons of I'm also highlighting, and you can even share your examples or guidance on this, is that this has led to actually an amendment to IAS 16 also. So if you look at practice, like I said, there we found various instances wherein the testing, in some cases, the income from the testing period was taken to P&L, and some actually adjusted it from their cost of the testing. Because there's, like I said, a lot of judgment involved as to when the testing period is over. Because of this liberal or a very liberal use of this testing period, globally there was concern and they said, fine, we are going to change the requirement itself. Now, IAS 16 does not permit a company to offset income during the testing period from the, now you will take the income during the testing period to your P&L. In India, we have still not converged with that. We continued with the earlier position of IAS 16, wherein income from the test runs will still be reduced from the testing expenses. And therefore, for us, this issue as to what is income during the test, or what is the test run, let me put it like this, becomes very critical because this significantly impacts whether the item will go to P&L or whether it will be adjusted from the cost of the asset. So if you want to share some thoughts on the...
Actually, you are very right. Internationally, this what is testing period, they have even defined in the revised IAS 16. What is testing? Because they have brought in the physical, that the asset is physically ready. I mean, it is not there in our standard, but they have brought in that physical completion, technical, physically, it is complete. So the testing has been very strictly defined. Right? In some of the opinions, earlier EAC opinions, we have even gone to the extent of commercial readiness and things like that. So you are right that IAS 16, and actually, I may also mention that here, Parul can confirm. Here the question, the focus was not on testing.
Yeah, I just said I'm using the opportunity to...
Yeah, the focus was not on testing. Otherwise, what we have done in the case of one opinion, in order, what is testing, we have borrowed the language of IAS 16 to say what is testing, not that income part.
Understood.
Only what should be considered as testing, because this, in our view, our India 16 is silent on that aspect, what is testing. So, from that perspective, what is actually testing, we have borrowed the language of the IAS 16 and used it in one of the opinions. Here, since the focus was not testing, so we have not gone into that question.
This issue wouldn't have come up if we were aligned with IAS 16, I feel, to quite an extent.
Yeah, but you're right.
It still costs them more. They're concerned about not just the income.
But you're right. That, so therefore, it has to be used very carefully. So the couple of points which you have also mentioned with regards to...
And sorry, sir, before you go to the other point, on this test runs only, if I can just, because we have the benefit of having you in this call, I think a good answer, I mean, I understand the practical challenges which we've observed. A good answer would have been to have a, what do you call, correct is the wrong word, but it's too much of to expect, but a good implementation of the requirements of the standard. I think even conceptually, just taking everything to P&L also has its own conceptual arguments as to whether you should do that or not, and I think that is very different. I think IASB did it only because they didn't want to leave it to the judgment, and again we left with the...
It was primarily the concern was what is the cost of testing.
Right.
That was the primary concern before the IASB. Yeah. How to arrive at the cost of testing, there was a lot of disagreement on that. So, because it is not if you have to take to P&L, you will have to take the P&L, the cost of the materials, etc., whatever are produced during the period. So that is one part, and then what, how would you recognize the income? You know, actually, this, as far as India is concerned, we are digressing a little bit. But in India, we have already, since long, we are adjusting the income during the construction period along with the costs. I mean, since initially no P&L was prepared, so it was always adjusted against the cost of construction and things like that. So it is a kind of a legacy question which continues.
So just to clarify, under IAS, the cost and income both from testing will now go to P&L. So they've taken everything there.
Yeah.
It's not just the revenue, so it's the cost also which will go to P&L. For us,
Yeah.
both are still under covered by
Yeah.
that.
So, for example, if during construction you are producing some, say, some output, like in this case, dishes. So the material cost of dishes, labor cost of dishes, since income is going, the cost of those dishes is also.
Yeah, I appreciate. That's the point I was trying to make, is that maybe this change in IS 16 would not have been needed, like you just said, because the issue was what is testing. Now, what is testing was being, that's what I said in the beginning, was being interpreted in a very loose manner. And many items which should actually were post testing were still being classified as a testing period expense and an income. I think a good answer would have been if we would have been able to get more clarification or guidance, but somewhere there will still be, for example, some judgment required as to whether or not there is a testing period. So I think they took a easier, not an easier, but like a rule-based thing that take everything relating to testing in the PNL. So that kind of just takes away the judgment of the company.
So actually, there is lot of things can be discussed here. Actually, that is what is done in EAC also. But since we have constraint of time, so maybe we can go to the next.
Yes. Next query is it is related to the discounting arrangements, and this practice is followed by many companies to which India's or IGAP is applied. So in our case, the company is in the business of generation of power, and this power is then sold to the distribution companies at the pre-decided or their agreed amounts. So every month, this power generation company raises bill to the distribution companies, and they have credit period of around 45 days to settle their dues. So the company and power generation and power distribution companies have option to settle their dues by discounting through the banker. So in this environment, uh, the company gets the full amount from their customer, and the bank charges commission or interest to this power distribution companies. And in case of their default, generally in this case they have specified that no default have been or no dishonor of bills have been incurred in the past. So uh, in case if we assume there will be any default, so the power generation company will be liable to pay to the banker. Now in this practice, company has done, they have de-recognized the financial asset. They have booked through the bank debit to trade receivable or sundry debtors. Now the question which is coming in this opinion or query, that whether we should de-recognize the trade receivable or we should book another financial liability, and at the end of that credit period we should offset the same. What should be done in the books of accounts? So I will request sir to give your opinions. Ma'am.
So I think again here I like to first have a conceptual discussion. Now, in this case, if I recollect, it says the customer also has the option to get the discounting done, right? Now, for the customer, this is a trade payable, right? So first, I think the overall this one in the fact pattern, if you look at it, there is full recourse. I mean, the power has been supplied to the customer. The customer is required to make the payment within 45 days, and either party can get the amount discounted. Now, even if discounting is happening, right, the banker is settling the bill on behalf of the customer. If there is a default later in the payment, there is a full recourse available. If I recollect, there is a full recourse available to the with the company, right? So the company has got the money. If there is a default, it will need to repay. Now let's look at the requirements of the standard. For the company to be able to de-recognize any asset, you need to demonstrate whether de-recognizing asset or liability. First, you see whether the company has been discharged. This is a liability, right? Okay, I'm just sorry, going to read out some of the facts of the arrangement. So this is a type of a bill exchange which is with full recourse to the company, and there are discounting charges wherein the discom will pay the discounting charges upfront to the banker through the company on the date of discounting. Now, if there is a full recourse and the parties are not relieved of their obligation to make the payment, there is no risk and rewards which are really getting transferred. As like I said, the discom will also pay the discounting charges upfront, and also if you go back to the fact pattern, if there is any default, they will also the company will also pay the interest during the default period. So the discounting does not really relieve the customer of its obligation to pay. There is no transfer of risk and rewards to the banker. And from a standard perspective, this does not meet the de-recognition criteria. Yeah. So I think that's all in this fact pattern is relatively clear. I just wanted to take a further angle to this that if you look at the arrangements which are happening today, this is titled as a simple bill discounting. But let's say I am a supplier and I have a customer. The customer needs to pay me, let's say, within 45 days, right? So between the supplier and the customer, there is an arrangement wherein I can get the money either on 45 days from the banker and the customer pays to the banker later, or the other is I can discount it from the bank within, let's say, 15 days or 20 days. Now, the question is that what kind of an arrangement is this? Who's really taking the loan? Is it the company, the seller, the supplier which has taken the loan, or is it the customer which has taken the loan? Now, that you will need to kind of assess looking at the facts and circumstances of each transaction. Basically, to see who benefits from the overall arrangement. Now, if the arrangement has been done so that the customer is able to take the benefit of an early payment discount, and that is why they're saying, okay, you pay to the bank pays to the supplier in advance, and the customer will pay to the bank later. Then it is for the benefit of the customer, right? And customer is the one who owes it to the banker. So the other is to say it is done, the arrangement is done for the benefit of the supplier, wherein the supplier has actually just discounted the trade receivables, and that is where the accounting can really differ. In this case, I think the case is simpler because either which way there is full recourse. The banker is only kind of extending a loan. There is no transfer of the rights and obligation between the buyer and the seller remain the same. There is no transfer of the risk and rewards to the banker. And if you look at the requirements of India's 109, it says that you can de-recognize an asset when first you look at, when you look at the asset, there are contractual inflows that you get from it. So one, either the contractual inflows have expired, Second, if that hasn't happened, you see whether the risk and rewards have been transferred. Now, let's say when you look at risk and reward, there again, you conclude it is not clear. You may come to a situation, you say it is not clear whether risk and rewards have been transferred. In that case, then you will look at who has control. So again, to repeat, first you look at the contractual cash flow. Second, you look at risk and rewards. If you're not able to decide even after looking at risk and rewards, then you look at the control situation. So here, in this case, first the contractual cash flows had not expired. When we come to risk and rewards, it is very clear that risk and rewards have not been transferred because there is full recourse to the company, and therefore I wouldn't actually even go to the control bit, and therefore the derecognition criteria doesn't get met. Yeah, that's broadly the theme of this EAC opinion. There could be many more variations. Again, please note in this case, I'm repeating, there is full recourse. The discounting charges were paid upfront. In case of default, the bank will still get full interest over it. This is a simpler one. Many bill discounting arrangements may not involve a full recourse. They may be either without recourse or they may be recourse to a particular percentage. Let's say they may say the recourse is to the first 10% of the default, or it could be a recourse to overall 10% of the default and so on. Those situations are separate. The CAC opinion does not address those situations, and that will require a very careful consideration of the requirements of the standard. Do you want to add anything here, sir?
No, I think it's a straightforward case.
Yeah.
So there could be many variations of course.
So the company will separately show this trade receivable and this financial liability as at the cutoff date.
Yeah. But if I may add here again, sorry, Bharat, I'm just going a little beyond. In this case, it says bill discounting. We've not really gone into the nature of the instrument, but if you look at the recent amendments to Ind-AS, there are specific amendments to Ind-AS 7 which talk about supplier financing. Here we've not gone into assessing whether this arrangement meets the supplier financing arrangement. Like I said, I tried to explain a supplier financing arrangement earlier with a very simple example. If it is supplier financing arrangement, there are specific disclosure requirements in the cash flow statement you need to consider. Here, the issue has been considered more from the supplier perspective, right? For the supplier, whether to de-recognize the trade receivable. But if I was to turn it around and look at it from a customer perspective, and that is the reason, sorry, I got mixed up in the beginning. If I was to look at it from the customer perspective, for whom it is a trade payable, if this arrangement was to meet the supplier financing definition, you will actually have an additional requirement to see whether the customer should continue to disclose this as or classify this as trade payable or as a borrower, right? So the overall arrangement becomes whether it is for the benefit of the borrower or whether it's for the benefit of the supplier or the customer becomes important. And depending on that, the accounting in the books of the customer also will be very relevant in terms of its classification as trade payable or borrowing, as well as disclosures in the cash flow. So this requirement, while the classification is trade payable or borrowing for the customer, those considerations would have always been applied. I don't think there is any change in the standard for that. But from a cash flow perspective, now specific disclosures have been added, right? Which just kind of connects. Here, accounting is from the books of the supplier. For the supplier, it's an easier one. It's a trade receivable with full recourse. It's just, you can take it as if I use trade receivable as a collateral in a very simple manner. But there's been no release of liability.
Thank you, ma'am, for your views and touching these recent amendments on the supplier finance in Ind-AS 7 also. So, moving on to the next query. in this scenario, the company is in the business of fertilizers, and the government of India regulates the prices at which these fertilizers will be sold. Now, in this case, the company is selling the fertilizers to these dealers, and the dealers are further selling it to the ultimate consumers who are the farmers. Now, under this direct benefit transfer or this subsidy claim, the company, the first channel will be entitled for this subsidy or the benefit at the time when the fertilizers are actually sold to the farmers, not to the dealers. So, in this case, what is happening? This government subsidy or this fertilizer rates are changing on half yearly or quarterly basis. So, when there is a stock lying at this dealer level, so the benefit which is receivable from the government by this first company will differ. So this stock is termed as the channel stock, and in this scenario, what is happening? The goods are sold by the company, let's suppose in the period one, but the same is sold by the dealer to the farmers in the period two. And the in if there is a change in this subsidy from period one to period two, the the company's revenue, who's making the supply to the dealers, will change, but it will change in the period two, because the claim will be settled when the fertilizers is actually sold to these farmers. But the change in transaction price is booked in the next period. So we are not directly following the materiality concept, not materiality, matching concept. So they were proposing that in this selling price, there are two components, fixed component and this variable subsidy component. So they will book both the components in the ratio of their cost, thereby adding this cost to this closing stock. And they were suggesting that it will comply with the provisions of matching concept. So now they are asking the same from the expert advisory committee, that this proposed method is in line with the India's or not. So, what should they do? Uh,
Thank you. Basically, there are three questions involved in this query. One is recognition of revenue from sale of fertilizer to dealers. The second is recognition of the fertilizer subsidy. And the third is the recognition of the related costs. I mean, broadly, these are the three questions which are involved. So, in the scope exclusion paragraph, the committee has not gone into the question of how to present these, subsidies, etc. But there we should be presented. Now, of course, that is a very important question also, whether other operating revenue or other income or in the current scenario, and of course, while coming to India's 118, the presentation can be different. So the committee has not touched upon. We will also not touch upon those aspects. Now, here it is important to understand that the application of 115 and the application of India's 20. With regard to the application of 115, India's 115, the committee looked into the definition of what is a contract, what is a customer, what is a transaction price, and things like that. I will not go into that in the interest of time. So what the committee concluded in nutshell was that the company's customer is the dealer, and the dealer's customer is the farmer, right? So from the perspective of the company, the manufacturer of the fertilizer, it is the revenue which it recognizes from the perspective of its sale to the dealer. So in that part, the transaction price will not include the subsidy component. So the subsidy component should be governed by India's 20. So that is broadly the whole structure of the opinion. So insofar as the recognition of revenue from sale of fertilizer to the dealer is concerned, the committee noted the requirements of this para 31 of 115 that when a company satisfies the performance obligation, then it transfers control to the customer. So here the committee has added one presumption that the committee says that we have not assessed at what point of time the control has been transferred to the dealer. So they presume that the control is transferred at the time that the fertilizer is sold to the dealer or delivered to the dealer. So it obtains control at that point of time. So therefore the committee concluded that what the company is doing insofar as the recognition of revenue to the dealer is concerned, it is right that at that point of time you recognize revenue. Now coming to the question of recognition of grants, because the committee then looked into the requirements of India's 20, definition of government grant, the recognition criteria, and the other relevant aspects. So the committee concluded that this subsidy, which is received by the company from the government, is received is a government grant, and therefore it falls within the scope of India's strategy, and it should be accounted for in accordance with India's strategy. So that is what with regard to the government grant is concluded. Now the basic question was that at what point of time the grant should be recognized. So insofar as that part is concerned, the committee noted that the purpose of giving this grant is to compensate for the costs which are incurred by the company or for the loss of revenue. So in other words, the grant in a way is related to the revenue aspects as such. So therefore, these should be recognized, the grant should be recognized at the point of sale to the dealer. At the point of the sale to the dealer, even though within the scheme it is mentioned that the grant is receivable when the dealer sells it to the farmer. Of course, the committee added a very important caveat in that in India's 20, there are requirements with regard to the recognition of the government grant that it should be recognized at the time when you have the reasonable assurance that you will receive the grant. So the committee said that, okay, you can recognize at the time when the sale is made to the farmer, provided there is a reasonable assurance that you will receive the grant from the government. In case there is any doubt that you will not receive the grant at that point of time, and there is no reasonable assurance for that particular aspect, then you defer recognition of the grant till the dealer sells it to the farmer. So that is a very important, part of the opinion that the committee says that the basic factor to be considered is the reasonable assurance at the time, the reasonable assurance, but it can be recognized at the point of sale to the dealers themselves, because it is related to compensate the loss of revenue or the cost as such. So revenue when recognized, so that is the triggering point. Now, with regard to the, the queries had mentioned with regard to the, bifurcation of the costs, that because this revenue grant would be recognized later, and therefore allocate the cost of the manufacture of the corn and manufacture of the fertilizer into two parts, one related to revenue, another related to grant. So the committee did not agree with that. The committee was of the view that neither Ind AS 2, when we talk of inventories, nor Ind AS 115, nor Ind AS 20, nowhere it has been mentioned that you can bifurcate these costs. So the costs will have to be recognized in the period when the fertilizer is sold to the dealer. Only thing is to be seen is that whether the grant which you have to receive, because of the factor that there is no reasonable assurance to be reasonable assurance, you may have to defer it, but that does not mean that you have to defer the cost also. So that is broadly the opinion. I have not gone into much detail because it is already 4 o'clock. So I have not gone into too many details about the opinion. But broadly, that is the opinion of the EAC. And with regard to the changes, because it is mentioned that the rates of the fertilizer, they keep on changing, and therefore, once you have recognized the revenue, if you recognize the revenue thereafter at the point of sale, and when you sell to it is sold to the farmer, the rate of subsidy may change. The committee said that it should be treated as a change in accounting estimate, and it should be changed prospectively. It should be accounted for prospectively in accordance with the requirement of Ind AS 8. So that cannot be the ground of deferring the recognition of the grant also to the later part as it has been mentioned. And actually, I may mention that in the query part, the query started lot about the matching, etc., matching principle. But in the conceptual framework for the information of everyone, there is no matching principle separately discussed in the conceptual framework currently. So whatever is to be determined, cost and the revenue, it has to be in accordance with the relevant accounting standards. So therefore, one cannot argue on the basis of the matching, which used to be a long time ago a principle of accounting, but it is no longer a part of the conceptual framework as such. That's all I have to say.
I'll just take 1 minute, sir. So one is, I think, I appreciate what you said, matching principle not there in the conceptual framework.
Yeah.
I wouldn't say it's totally gone away. I would rather say it's been de-emphasized. If the standards take it into account to the extent relevant, if the standards do not talk about it, we do, where there is lack of guidance, you may at times use, it could be one of the factors to be applied, not the only factor. So it's been de-emphasized. Not the only factor. So I would say it's de-emphasized, not totally gone away, depends upon the overall. And I think in this one, sir, the point which I would just take away even for the participants is that you just see what are the components. It's not that when there were, you spoke about whether the cost can be split into two. So these are not two separate components. There is a single component as far as either the purchase is concerned or the sale is concerned. So the question of splitting either the cost into two doesn't come. And I think the only interesting thing I liked about this opinion, which though sounds very basic, is that we said, you see, what is this grant coming for? Is it for reduction of cost, which clearly it isn't. It is for basically to compensate for the loss of revenue, and that is why you're applying when the condition is met. If I recollect, maybe decades ago, there was an EAC opinion wherein for fertilizer it said if there is very significant variability, you kind of did it only when the fertilizer subsidy rate was known. I think, I'm just talking from my memory, but that time the fertilizer subsidy worked also in a different manner. I think this is an interesting one because here it permits you, it recognizes. See, one is the right that you have to the subsidy, and second is the measurement. So at least once you meet the conditions of India's 20, your right to subsidy is established. I think then comes the issue of measurement. And this opinion therefore supports that just because there is some estimation required for measurement doesn't mean you postpone. I think, and that's the flavor we get even in the newer standards when you look at 115 also, India's 115. Earlier, if there was uncertainty in measurement, many postponed. Now we're saying it's variable consideration. So the same theme I see here, that you make a best estimate and then you throw up for the estimate once that uncertainty is settled. So I think that's, at least for me, that's the key takeaway from this.
Thank you, C. Archana Bhutani and Dr. Avinash Chandraji. And on behalf of this expert advisory committee, I am thankful to both the panelists for beautifully explaining these thin line differences, these complex issues, and I am very much confident that this will benefit our participants and me a lot. And both of you have touched the what is happening outside India in this IESB and some other jurisdictions also. So
thank you. Thank you. Yeah.
Thank you.
Yeah. Thank you all for joining today's webinar, and we appreciate your time and engagement in the webinar. And special thanks to our speakers, today's speakers, Dr. Avinash Chandraji, C. Archana Bhutani, and moderator of the session, C. Prashant Gupta ji, for taking out their invaluable time and steering the webinar. Thank you all. Good evening. Tech support, you may conclude the session.
Recording stopped.